Hello, everyone. Welcome to MSS Mentorship and Online Classes. I am Mohamed Sheksisi, your tutor and your mentor. So basically, as per the timetable, we are going to cover some accounting standard today. That is IAS 36, impairment. We are going to look at provision, and we are going to look at IAS 2, inventory. So these are the three accounting standards that we are going to cover for today's session. Then also on Thursday, we are going to complete ratio analysis because we have started to look at ratio analysis, looking at the formula and looking at how to do some analysis. So basically, let me share my screen. Right? Are you guys see my screen, right?
Yes, sir.
Very good. So basically, when we are talking about impairments, according to IAS 36, now let me give you the general concept about impairment. If we are going back to the definition of an asset, based on the conceptual framework, we need to have three features before we are going to consider any transaction to be recognized as an asset in the financial statement. First, it has to do with the controllability. We should be able to control the asset, the utilization of the asset, and also the economic benefits that the business will receive as a result of the asset. Then finally, the past event. So now, whenever we are talking about the economic benefits, for example, a company decided to purchase new machine with the expectation to improve on the production capacity from 10,000 to 15,000, for example. So now, if that particular machine can achieve the economic benefit, the production capacity of 15,000, so it means that machine can give the company the economic benefit that the company is required to support or to be in operation. But now let's assume during the passage of time, 1, 2 years, based on some natural situation, the production capacity of the machine has reduced significantly from 15,000 to 12,000, for example. So now, whenever there is a gap between the economic resources that the asset should provide, that will precipitate the concept of impairment. In other words, it's a clear indicator that the asset has been impaired. So we have the concept of impairment when the economic resources, when the business cannot achieve or fully utilize the economic resources from that particular asset. That's the time we have the concept of impairment. In other words, the asset value has significantly declined as compared to the initial economic benefit that the asset is being provided for the business. So this is the concept of impairment. So now we are going to look at how we can account for impairment and how we can account for impairment for a cash generating unit, which is very much important for the examination. Then it is mostly tested in the examination, the CGU, the cash generating unit aspect of impairment. So throughout this session, we are going to look at the scope of IAS 38, sorry, 36. Sorry, let me join this newcomer. So we are going to look at so as I was saying, we are going to look at the objective and scope of IAS 36, which is impairment. And also we are going to look at the conditions of impairment, and we are going to look at how we can calculate and allocate the impairment for the cash generating unit, the CGU. So basically, when we are talking about impairment, the objective of IAS 36 is for us to ensure that the carrying value of the asset is not more than the recoverable value. This is the key concept of impairment. The entity assets or the carrying value of the assets are not more than the recoverable value. When we are going to look at it further, we can distinguish between the components of the recoverable amount, which is clear. So now, we have exception which we can't apply the IAS statistic in the scope. For example, if you're talking about inventory IAS 2, we are not going to apply the concept of impairment because by default, the measurement of IAS 2, the inventory, which is the law of cost on the net realizable value, by default, it contains the element of impairment. Because if the asset value, the cost of the asset is greater than the recoverable value or the net realizable value, then we are going to ensure that we take the lower of the cost and the NRV to be the current value of the inventory. If we are going to look at construction contracts under IAS 11, it's exempted from the IAS 36, deferred tax, IAS 19, employee benefits, IFRS 9, and IAS 39, as well as non-current assets held for sale and discontinued operation, which is IFRS 5. So now we need to know some few definitions, because when we are talking about impairment, if the carrying value is greater than the recoverable value, then it is clear indication that there is an impairment. The asset has been impaired. The value of the asset has significantly reduced. So when you're talking about carrying value, we all know this is the value after we have deducted accumulated depreciation or amortization or any impairment loss. The remaining value that will be is what we refer to as the carrying value. So now when we are talking about the recoverable value is the higher of the fair value less cost to sell on the value in use. So now, for us to calculate our recoverable value, we can either use the higher of the fair value less cost to sell and the value in use. So now, what is fair value less cost to sell? If the company decided to sell the asset, the current market value of that asset is what we refer to as the fair value. Now, it's obviously that the company will incur some costs to ensure that the process of selling the asset is finalized. So if that is the case, the cost that we are going to incur to support the sale of this particular asset, we are going to deduct it from the fair value. So the fair value less cost to sell is the fair value minus any cost that we are going to incur to support the transaction. Now, the value in use, basically, the company might have the option to continue the utilization of X, Y, and Z assets, for example. So if that is the case, if the company has decided to continue the utilization of these assets, we want to know what will be the future cash flow that the asset will generate. If we know the future cash flow that the asset will generate, it means we want to know the value in use. If we are going to continue the utilization of the asset, what future cash flow are we going to generate from this asset is what we refer to as the value in use. That's why for the value in use, we need to discount the value back to its present value so we can able to compare like with like. But don't worry, when we are going to look at calculation and illustration, you can able to understand better. So for now, what you need to know that when we are talking about impairment, it means when the carrying value of the asset is greater than the recoverable value. Simple. When the carrying value of the asset is greater than the recoverable value, then there's an impairment. The recoverable value can either be the higher of the fair value less cost to sell and the value in use. We can either use the higher of these two. If the fair value is greater than the cost to sell, if the fair value less cost to sell is greater than the value in use, then we are going to use the fair value less cost to sell. If the value in use is greater than the fair value less cost to sell, then we are going to use the value in use. We are going to use the higher of the two to ensure that we calculate our recoverable value. So this is the concept. This is what exactly you need to know for the examination. Impairment is when the carrying value of the asset is greater than the recoverable value. And the recoverable value can be calculated as the higher of the fair value less cost to sell and the value in use. Basic concept that you need to know. And it is very much important because when we are going to look at the multiple choice questions, this will be tested frequently. So basically, this is just an explanation about what you need to know. Then also, we are talking about the impairment of individual assets. For example, we are talking about the property, plant, and equipment. We are talking about the motor vehicle. We are talking about machinery. How are we going to impair? How are we going to write down the value of the asset for individual? Because we have the concept of impairment for a group of assets, of group of identical assets that we can classify within the cash generating unit. That we are going to look at it separately. But for now, we need to know how we can impair individual assets in the financial statement. So basically, this is what you need to know from the diagram. The impairment, we can only get impairment when the carrying value of the asset is greater than the recoverable amount. Again, we are all see the sign of the greater than. The carrying value is greater than the recoverable amount. That's the time we are going to get our impairment. Now, for example, in real life, let's assume the company has a motor vehicle, for example, a motor vehicle. During the operational process, the motor vehicle involved in significant accidents. So by default, the motor vehicle can't provide the future economic benefits from that particular asset anymore because the asset has involved in accident and the value of the asset might fall from the original value to the current value now. So if the company decided to sell that particular asset, it will not sell it above the carrying value. So in that particular situation, we can say the carrying value is greater than the recoverable value. And the recoverable value can either be the fair value less cost to sell or the value in use. The greater, the higher of the two is what we are going to use as the recoverable value. We are not going to add both. No, we are going to calculate the fair value less cost to sell and the value in use. If the fair value less cost to sell is 10,000, for example, and the value in use is 8,000, it means the fair value less cost to sell is greater than the value in use. Then at that point in time, we are going to use the fair value less cost to sell as the recoverable amount. Or we are going to do the alternative. If the value in use is greater than, let's assume the value in use is 15,000 and the fair value less cost to sell is 8,000, then we are going to use the value in use instead of the fair value less cost to sell to be the recoverable amount. So this is the key concept that you need to know. All other aspects of impairment will be subject to this fundamental understanding of impairment. So we can only get impairment when the carrying value is greater than the recoverable value. So basically, let's just do some warm up so we can able to understand better. Illustration, recoverable value. The question, what is the recoverable amount of the asset? What is the recoverable amount of the asset? Calculate the impairment loss for each of the three assets. The carrying value, for the first requirement, for A, we need to know the recoverable value. For A, the recoverable value will be the higher of the fair value less cost to sell or the value in use. And the fair value less cost to sell for A is 110 and the value in use is 120. So therefore for A, we are going to we are going to take 120 to be the recoverable value. Are we together? The 120 is what we are going to use to be the recoverable value because it is higher than the fair value less cost to sell. The fair value less cost to sell is the same as the net realizable value. For asset B, the recoverable value will be 125, which is the net realizable value, compared to 130, which is the value in use. And based on the concept, according to IAS 36, we are going to use the higher of the two. So for asset B, we are going to use 130 to be the recoverable value. I'm not talking about impairment, I'm talking about the recoverable value. Based on the requirement, we should first identify the recoverable value from the various assets given in the question. For asset C, the net realizable value, which is the same as the fair value less cost to sell, is 100 and the value in use is 90. So it means for asset C, we can use the 100 to be the recoverable value. Simple. That is how we are going to identify the recoverable value from any given question. Now the impairment, we are going to compare the carrying value with the recoverable value. That's the time you're going to get impairment. If the carrying value is greater than the recoverable value, then there's impairment. But if the recoverable value is greater than the carrying value, then there is no impairment. There is no impairment. You need to get this point very clear. We can only get impairment when the carrying value of the asset is greater than the recoverable value. It means if the carrying value of the asset is greater than the recoverable value, it means the economic benefit that's supposed to be generated from that particular asset cannot be generated anymore because of the decline, the reduction in the carrying value of the assets to its recoverable value. So for asset A, the carrying value is 110 and the recoverable value is 120. So for option A, there is no impairment because the carrying value is less than the the recoverable value. For option B, sorry, just a minute, let me connect my writing pad. Okay. So for asset B, the carrying value is 150 and the recoverable value, which is the value in use, is 130. So the carrying value is greater than the recoverable value. So there is an impairment of 100. There is an impairment between the carrying value and the net realizable value, which is 20. 150 minus 130 is what we refer to as the impairment. So now just give me a minute. Let me open the. Okay, we're talking about impairment. Let me open the Word document so we can able to. Are you seeing my screen, right?
Yes, sir.
Okay, okay, okay. Okay, let's continue. So very good. So for asset C, are we together? For asset C, the carrying value is 120 and the recoverable value, which is the 100, the net realizable value. So in this situation for asset C, there's an impairment of 20. So basically, this is the concept. You need to compare the carrying value of the asset with the recoverable value, and the recoverable value is the higher of the fair value less cost to sell or the value in use. So now basically in the year life, there should be an indicators of impairment. And also we need to know when are we going to test for impairment, which is very important. We have two categories of impairment, indicator of impairment. We have the internal indicator, we have the external indicator. So basically, you need to know that whenever there is an impairment, there must be an indicator of impairment. So according to IAS 36, it requires for certain type of assets at each reporting date, we need to do some assessment. We need to do some impairment assessment to confirm whether the asset value has significantly declined, has significantly reduced as compared to the carrying value. We need to test on annual basis. We need to do general assessment on the value of our assets. So as a result of that, we have the internal source of impairment indicator and we have the external. So when we are talking about internal, it can be any situation that might internally, for example, we have a machine that used to produce 15,000, but because of the age of the machine, it can't produce 15,000 quantity anymore, but its production capacity has reduced to 12,000. So internally, it's an impairment indicator. So we can flag it up that we need to do impairment assessment. We need to do impairment review on this asset. However, very important point, we need to note this point down. When to test for impairment, it is very important we note it down. When are we going to test for impairment? We have certain categories of assets that we are not going to do some impairment test on. By default, on annual basis, we are going to do impairment tests. We can't wait for any indicator before we are going to do impairment test. So we need to know this category of assets, and in examination, it is frequently tested. For intangible assets with indefinite useful life, when we are talking about intangible assets, we have covered it. Yes, intangible assets with indefinite useful life, for example, or goodwill acquired under the business combination according to IFRS 3, or intangible asset not yet available for use. So these three categories of assets, these three categories mentioned in this particular situation must be tested for impairment at least annually. It is a must. On annual basis, at least once, at least on annual basis, we should test these categories of assets for impairment on annual basis, whether there's an indicator of impairment or not. We are not going to wait for any indicator of impairment, but we are going to do some impairment tests at least annually, regardless of the situation. When we are talking about intangible assets with indefinite useful life, it means assets that we do not have a specific end time for that particular asset. For especially when you're talking about intangible, if there is no specific end time, it means that asset has indefinite useful life. So on annual basis, we are going to test for impairment. Also for goodwill that is acquired, I'm talking about purchased goodwill. I've already distinguished between internally generated goodwill and purchased goodwill under IAS 38. So for purchased goodwill, goodwill that is acquired under the business combination should be tested annually from impairments. Finally, intangible assets not yet available for use. We are going to test it for impairment on annual basis. At least we should test it on annual basis. So you need to know these 3 points down. It is very important. You need to understand this point. For all other assets, an impairment test is required only when there's an indication that the asset might be impaired. For all other assets, in exception of the three mentioned above, we should do some impairment tests only and exclusively when there's indication of an impairment that we need to see clear indication. For example, the motor vehicle involved in accident, that is a clear indication of impairment, or the significant change in the components of the motor vehicle is an indicator of impairment, or due to the economic situation, we can't, or the economic weather, we can't use this type of motor vehicle or machine in the production process until further notice. It's an indication of impairment. We need to see some things that will bring, that has the propensity to bring the value of the assets below its carrying value. That is what we refer to as the indication or the indicators of impairment. So you need to know this point very well. For intangible assets with indefinite useful life, for goodwill, an asset, an intangible asset that is not yet available for use, we are going to test for impairment at least annually. You can do it more than annually. You can do it more than one time per year. But at least we should test it for impairment on annual basis. Second point, all other assets, with exception to the above mentioned, should only be tested for impairment when there's indication that the asset value has significantly declined from this value to this value, which is clear. Now we are going to look at the indicators of impairment. As I mentioned earlier, we have external indicators, we have internal. External indicators can be market value. This is frequently tested in the exam. It can be a significant changes which is adversely affect the technology. For example, it is normal. We all can see it. The iPhone users, now we can iPhone 7, iPhone 8, iPhone 10, they are obsolete in substance because no one wants to use that type of iPhone anymore. Now we are ranging iPhone 16, iPhone 17. Why? This is a clear indication of impairment because the value of the iPhone has significantly changed due to the technological advancements. So this will be an external indicator of impairment. So any company that is operating in a technological business needs to be mindful about the potential impact on potential impact the impairments might have on their business operation. Yes, Laratu. Class day on, ma. Class day on. Talk to Ipadile for them for you. I'm not going to go on. I don't session. Sorry, guys. So also increase in market value. For example, we are talking about interest rates. Currently the situation in our country, Sierra Leone, we have the major issue of exchange rate, the dollar and the leones. It is possible that the exchange rate has increased from one point to another. That is an external indicator of impairment because if the exchange rate increases from one point to another, it will affect the economy, it will affect our asset value, it will affect every other factors. So that also is an external indicator of impairment. Now we are talking about internal indicators, evidence of Just a minute, let me add. And then okay, we can proceed. Proceed. So now we are talking about the internal indicators. For example, talking about physical damage, I mentioned earlier about the motor vehicle. The way the asset is being used has changed. For example, the assets used to produce 15,000, but due to one or two reasons, the production capacity has reduced from 15,000 to 10,000. It's an indicator, internal indicator of impairment. Internal reporting indicating that the economic performance of an asset is was over the expected period. As I mentioned earlier, if the economic benefit that we are going to generate from the asset has declined significantly, that is also an indicator of impairment. So you need to be aware of the external and internal indicator of impairment. So now, very important concept. We are going to look at the recognition and measurement of impairment. As I already mentioned, we need to know how to calculate the recoverable value, and we need to know how to calculate the carrying value. We need to know how to calculate the recoverable value, which can be the higher of the fair value less cost to sell and the value in use. So basically, we don't have anything to worry about that the above. So we need to look at this solution. Let's understand it from example one. The recoverable amount concept. An entity owns a car that was involved in an accident at the year end. It is barely usable, so the value in use is estimated to be 1,000. However, the car is a classic and there is a damage for the part. This results in the fair value less cost to sell of 3,000. The opening carrying amount was 8,000 and the car was estimated to have a life of 8 years from the start of the year. So basically, the question stated that identify the recoverable amount of the car and the impairment. It's very simple. you know, you can go through the recording session, the solution is there. But basically, let me just explain from the above. The first requirement is talking about the identification of the recoverable amount. And based on the concept, according to IAS 36, the recoverable amount is the higher of the fair value less cost to sell and the value used. And the fair value less cost to sell in this question is 3,000, which is given in the question, and the value in use is 1,000. So therefore, the recoverable value will be the higher of the fair value less cost to sell and the recoverable value, which is the 3,000, is what we are going to use as the recoverable value. So now we're going to calculate the impairment, but before we are going to calculate the impairment, we need to calculate the carrying value of the asset. From the question, the opening carrying amount was 8,000 and the car was estimated to have a useful life of 8 years. So we need to calculate our depreciation from the assets. So we need to depreciate the assets 8 years, and also we have used the car for 3 years based on the question. The date did not mention in the question. So therefore we need to calculate 3 year depreciation, which is 3,000, and the current value of the asset is 5,000. So basically, what you need to aware for now is how you can calculate the carrying value and how you can calculate your recoverable value. When you understand that concept, then you will be in a better position to solve any question on impairment. So you need to know the carrying value. I'm going to repeat it again. The recoverable value is the higher of the fair value less cost to sell and the value in use. Why is the carrying value? Is the value of the asset after we have deducted depreciation and any other previous impairment. It's what we refer to as the carrying value. So from this question, the impairment will be 5,000, 8,000, which is the carrying value. There's no date in the question, so we don't need to worry about it, right? We are just explaining how to navigate between the recoverable value and the fair value less cost to sell. So also example two, You can see the solution, but um, I'm not going to solve it. I've already solved it in the recording session. That's why I'm expecting everyone to have completed the recording session so we can be on a better position to ask questions and to discuss. So now the key concept, how are we going to account for impairment? What is the double entry for impairment? Which is very important for you to note. When you're talking about impairment, you need to know the double entry for impairment. The double entry for impairment. So when you're talking about impairment, is the reduction in the value of the assets. So it means we are going to debit something and also we are going to credit something. So now assets has a debit balance. So if we want to reduce the value of the asset, we need to credit the asset. So we are going to credit the asset and also we are going to debit expenses. Impairment is an expenses. So this is the double entry that you are going to do. When you have calculated your impairment, you are going to show it as an expenses in the income statement, whilst we are going to credit our asset. We are going to reduce the value of the asset. So now we are talking about reversal of impairment loss. In a situation where we have recognized an impairment, we want to reverse based on the indicators that we should reverse our impairment. What are we going to do? Which is very much important. It is very much important you understand this concept. It is frequently tested in the examination. So basically, once we have calculated our impairment, the impairment loss is based on the predicted or the prediction of what may have happened in the future because the indicators might happen or it might not happen. So we don't need to worry about it. So we need to consider how we can do our impairment reversal. And impairment loss recognized for goodwill cannot be reversed. Very important point again, you need to know. Now, let's look at this point. Impairment assets should be reviewed at each reporting date to see whether there are indication that the asset has been impaired or reversed. The reversal of impairment loss is recognized immediately as an income in the profit or loss. Initially, we have recognized the impairment as expenses, but when we are going to do the reversal, we are going to recognize it immediately as an income in the profit or loss, provided that the initial sign or the initial indicator is no more an indicator of impairment. That's the time we are going to do our reversal. If the original impairment was charged against the revaluation surplus, which is very much important, when we looked at IAS 16, we covered the concept of revaluation. If there's the gain on revaluation, if the fair value of the assets has increased, then we are going to recognize a gain on revaluation. But if there's an impairment, we need to ensure we offset that amount first before we are going to account for any gain on revaluation. So this is the concept that we need to understand again. It is recognized as other comprehensive income and credited to the evaluation reserve. So we are going to do a reversal of what we have done in the evaluation reserve and what we have done in the income statement. What we are going to do. We are going to offset it against the other comprehensive income and we are going to credit the evaluation reserve. I'm going to encourage you again to look at the recording session because the time is limited. We have key accounting standard to cover. We have already utilized more than 40 minutes of the session. So going through the recording session will help us to discuss these issues and we will be in a better position to understand better. So for goodwill, we can't do any reversal on impaired goodwill. An impairment loss recognized for goodwill cannot be reversed in any subsequent period. So you need to know that for goodwill, you can look at the reason separately. So now basically, we have concluded the concept for individual asset impairment. So now we need to move to the cash generating unit. So when we are talking about the cash generating unit, it means we have a different small component of assets, identical group of assets that individually they can't generate the future cash flow. They are called future economic benefits. But when we are going to group these assets together, they can generate a cash inflow to the business. So because of that reason, we are going to account for these categories of assets as a single. We are going to calculate impairment. We are going to do our impairment review. We are going to do our impairment test, and we are going to perform our recoverable value on the group of assets, not the individual assets. So when we are talking about the cash generating unit, it means we are going to impair the group of assets, not the individual assets. Very important point to know. So now, what you need to know for the exam, which is clear, how we can allocate the impairment for cash generating units. That's what you need to know. The calculation is the same. We are going to compare the carrying value of the assets under the cash generating unit, and we are going to compare the recoverable value of the assets under the cash generating unit. So we are going to compare the cash generating unit and the cash generating unit of recoverable value and the cash generating unit of the carrying value. Then the difference will be the impairment, provided if the carrying value of the cash generating unit is greater than the recoverable value of the cash generating unit. That's the time we are going to get our impairment for the cash generating unit. So now the concept, this is what you need to know. This is what you need to know for the examination. In other words, after we have calculated the impairment for the cash generating unit, how are we going to allocate this impairment? Because what you need to know, the impairment is not for a single asset, it's for a group of assets. So we need to know how we can allocate these assets. That's what we need to know. How we can allocate these assets, how we can allocate the impairment to the various assets. So when you're talking about the cash generating unit, the first thing that should come in your mind is how you can allocate the impairment to the various categories of assets. Now, the first condition you need to know, for any impairment under the cash generating unit, we are first going to offset it against any purchase goodwill. Goodwill will be the first thing that we are going to offset. We are going to take off the impairment. The second aspect, if there is any specific asset mentioned in the question, that specific asset, we are going to impair that specific asset as well. Very important concept. When you're talking about specific asset, the question might give you the clear indicator that this asset has been impaired. So we need to consider it. We need to give preference to that particular asset. So first, we're talking about goodwill. Second, we are going to talk about specific assets mentioned in the question. The specific nature of the assets can be given in the question. The third aspect, the other assets, including other intangible in the CUG on a pro rata basis. In other words, the remaining assets, which is not goodwill, which is not a specific asset, we are going to prorate the impairment based on the value of the asset. That's how we are going to use to prorate. We are going to prorate the assets based on the carrying value of the asset. So these three concepts, you need to have it in mind when we are talking about the impairment for cash generating units. You need to be mindful, you need to understand this step. Whenever a question comes up in the examination on cash generating unit for impairment, firstly, after you have calculated the impairment, you need to allocate portion of the impairment to goodwill. If any impairment remains, then you're going to allocate it to specific assets. If any impairment remains, we are going to prorate it. We are going to attribute it to the various remaining assets using the current value of the assets. If you want to know how you can allocate it, go back to my recording session. You can see the process of allocation, right? So now note, very important, very important. We have specific type of assets that by default, the value that will be given is the recoverable value. So we are not going to charge any impairment for these categories of assets. No individual asset should be written down below its recoverable value. Now, also what we need to know, the concept of impairment is not for us to write down the value of the asset beyond or below the recoverable value. No, we need to write down the value of the assets at the recoverable value. Maximum, we should not go below the recoverable value because we want to reduce the carrying value of the asset to the recoverable value. So if we are going to reduce the carrying value of the asset so its recoverable value, it means that value should not go below the recoverable value of the assets. So this means that unless specifically impaired, current assets, note it down, current assets are unlikely to be impaired. as part of the cash generating unit. When we are talking about current assets, we are talking about inventory, we are talking about receivables, we are talking about short-term investment, we are talking about IFRS 5, non-current assets held for sale and discontinued operation. We are talking about cash and bank. Now, if this is given in the question, unless it is specifically stated that the current asset, the inventory, the receivable, the short-term investment has impaired. Other than that, if there is no specific statement to support or to juxtapose the impairment of that current asset, then we are not going to allocate any impairment for any current asset, because we are going to assume that the current assets are stated at their recoverable value. At their recoverable value. So it's very clear. You need to understand this. This is the key point for the cash generating unit that you need to know. Firstly, how to allocate the impairment. The second point, you need to know which category of asset that we are going to assume to be at a recoverable value. Only for current assets. Only for current assets, we are going to assume that the assets are stated at their recoverable value, unless if specifically mentioned in the question that the current asset has impaired. At that point in time, we are going to ignore the exception. Instead, we are going to impair the current assets. So basically, this is the concept, right? I'm not going to solve this. You can see the solution from the recording session. I'm just going to explain it so you can be able to understand the content of what I'm saying, looking at the allocation. So basically, from the question, Czech runs a unit that suffers a massive drop in income due to the failure of its technology on 1st January 2028. The following kind amount were recorded in the books immediately prior to the impairment. So we have goodwill, kind value of the assets, technology, kind value, brand, land, building, other assets. They are all in kind value. So now the kind value of the asset is 85 million. So now let's add the kind value 20 plus 20 plus 5, 25, 35 plus 50, 85 plus 10, 115 plus 40, 155. So 155 is the carrying value, and the carrying value is 85 million. So the difference will be the impairment. 155 minus 85 will be the impairment. So now the point I want you to know, 155 minus 85 is what? Is 70, right? 70. Right? So now we need to know how we can allocate the impairment of 70 to the above assets. So the goodwill, technology, brand name, land, and other assets. But we are going to read the question before. Firstly, what will come in our mind, we need to take off the goodwill. So we are going to allocate out of the 70, we are going to allocate 20 to the goodwill, which is clear. Then we need to read further to know how are we going to do the further allocation. The technology is worthless. The technology is worthless. It means we don't have any benefit that we can achieve from this technology anymore following its complete failure. So among the specific category of asset that we are going to consider to be specific from this analysis is technology. So we are going to impair technology 100% impairment, because the question clearly stated that the technology is worthless following its complete failure. So technology, we are going to allocate 100% of the impairment to the technology. So 20 will be allocated to the goodwill, 5 will be allocated to the technology. So the remaining 35, 70 minus 25, the remaining 45, we need to read further to know how are we going to allocate it. The other net assets, including inventory and receivable, the other net assets, it is considered that the current value of other net assets is reasonable representation of their net realizable value. So it means the carrying value of the asset is equal to the recoverable value. So we are not going to allocate any impairment for other assets, the 40. We are going to leave it as it is. So the remaining are the brand names, the land, and the building, 10, 50, and 30. So we are going to use the carrying value of the asset to allocate the remaining impairment of 45. You can go back to the recording session so you can be able to um, calculate it for yourself. So basically, look at the solution. You don't need to worry about anything. Um, this is what you need to know for impairment. So look at the kit question. You need to take it very serious because this is frequently tested in the examination. So, we can calculate. So for question one, the division of an entity has the following balance in its financial statement: goodwill, plant. So let's solve this question so that we can be able to have the gist of the examination, right? So we can copy the question. Oh, yeah, can I copy it? Okay. I don't know if I can able to paste it. I'm currently having challenges with my writing board, so that's why. Okay, so we can see, right? Are you seeing the question? Hello, guys.
Yes, sir. Yes, sir. Yes, sir.
Very good. So now from the requirement to the nearest thousand, what is the balance on plant following the impairment? So specifically, the question did not ask you to do the fully impairment allocation. We want to know for only plant what will be the value of the plant after the impairment. So you need to understand the requirement. You might be asked about building or intangible or other assets, whichever. So you need to know what you are going to find from the requirement. So we are going to consider plant only. However, we need to understand the whole concept because probably we are going to allocate first on goodwill, billing, whichever the situation might be. So now let's read the question. A division of an entity has the following balances in its financial statement. Goodwill, you can take out your calculator. You need to add the total assets for me. Goodwill is 700, plant 950, 2000, 2,300,000, 800, 430. The value of the assets, right? So you can add it for me. Then I need the value of the assets. So the total value of the assets will be 700 plus 950, right? Plus 2300 plus 800 plus 430. This is the value of the assets. So what is the answer?
4,480,000.
4480. We are going to take off the three zeros, right? So now we need to identify the recoverable value. This is the total carrying value of the asset. Total carrying value of the asset. So now we need to determine the recoverable value. So from the question, following the period of losses, the recoverable value or amount of the division is deemed to be 4 million. So 4 million is the recoverable value. 4 million is the recoverable value, right? So therefore, the impairment, will be the carrying value minus the recoverable value. So which is the 4480 minus the 4000. Are we together? So therefore, the impairment will be 480. Are you with me? Hello?
Yes, sir.
Fine. So we continue with the question, right? A recent valuation of building showed that the building has a market value of 2.5. The market value of the building is 2.5. The value stated above is 2,300. So it means the market value is greater than the value of the building. So we are not going to charge any impairment for the building, which is clear. Because the concept of impairment is telling us that the carrying value of the asset should less than the recoverable value, not more than. In this situation, this market value is the fair value less cost to sell. Specifically, it's more than the carrying value, which is 2,200. So we are not going to touch, we are not going to do anything with building. We are not going to impair the building. The building has not been impaired. So you look at the technique, look at the trap. So that's why you need to know your concept. When I'm deliberating on key things, you need to take notes and you need to pay attention on the concept. We can only get impairment when the carrying value of the asset is greater than the recoverable value. From this situation, the market value is the recoverable value and it is greater than the carrying value of the asset. So we are not going to charge any impairment on the building. Simple. The other net assets are at their recoverable amount. The other net asset, the four 130. They are their recoverable amount. So we are not going to allocate any impairment for the other assets. The entity uses the cost model for valuing building and plant. We don't care about that, right? So now we are going to allocate the impairment. We want to allocate impairment to goodwill, plant, and intangible assets. Therefore, we are not going to church with that again. So we are going to allocate the impairments to goodwill based on the concept. According to IAS 36, we should allocate for cash generating units. We should allocate goodwill, the impairment first to goodwill, second to any specific asset, then the remaining we are going to prorate it based on the carrying value of the asset. So we are going to implement the concept, right? So firstly, we are going to allocate it to goodwill based on IAS 38. Goodwill, 100%, 100% we are going to charge impairment, and the value of the goodwill is what? Is 700. So we are going to take off 700. Are you with me?
Yes, sir.
Hello, guys. Are you with me?
Yes, sir. Yes,
Yes,
sir.
sir. Yes,
Okay.
sir.
So now we need to take off the impairment from the goodwill. The goodwill is 700 and the impairment is 480. So minus 480. So in other words, the goodwill has fully utilized the whole of the impairment. Are we together?
Yes, sir.
Fine. So now, from this point in time, we don't have anything to do further because there is no outstanding impairment left in the question. So therefore, the plant value based on the question will be 950. This is what you need to do. You need to implement, can you, okay, you need to implement the concept when you are solving any question. So look at example, look at question 2. Nothing to worry about. This is past question. From question 2, the requirement stated that what is the recoverable amount of the vehicle following the accident? Please mute your mic, please. Hello, please mute your mic. Hello, are you guys with me?
Yes, sir.
Yes, sir.
Okay, so we continue, right? Example 2. The question stated that what is the recoverable amount of the vehicle following the accident? A vehicle was involved in an accident exactly halfway through the year. The vehicle cost 10,000 and had a remaining life of 10 years at the start of the year. At the start of the year. Following the accident, the expected present value of the cash flows associated with the vehicle was 3,400 and the fair value less cost to sell is 6,500. So now we need to, what is the recoverable value or the recoverable amount of the vehicle following the accident? Who can tell me what is the recoverable value? Very simple. We have the fair value less cost to sell of 6,500 and we have the value in use, which is the present value of the future cash flow associated with the vehicle, is 3,400. And the concept of IAS 36 is telling us that the impairment is the recoverable value is the higher of the fair value less cost to sell and the value in use. So now from the question, the value in use is 3,400. The fair value less cost to sell is 6,500. So what is the recoverable value? What is the recoverable value from the question? Man, normalist me.
6,500. I'm not sure.
Any other option? Cherno, any other option? Cherno,
Yes, sir. Yes, sir.
I call him there now.
Yes, sir.
What are the recoverable values, sir?
So yeah, I'm going to use the restroom. That's why.
Okay, so okay,
Sorry,
okay, it's fine.
I go use the restroom. Sorry,
Famata,
left my phone.
Famata, what are the recoverable value?
Sir?
What is the recoverable value? So now none of that with me. Tell the whole now.
Well, I read down.
Tell the whole now, Ben. I read my mouth. Wait for you. Exam not the fight again. No, I barely 6 weeks we get. 6 weeks.
Question 2.
No, question 11.
Uh, 6,500.
So basically, the correct answer is 6,500. Very simple. This is an objective test question. In the examination, you can use, up to 15 seconds to solve this particular question. So these are the questions that you're going to save time on. Because the question is simple. The question asks about the recoverable value. And based on the concept, it should be the higher of the fair value less cost to sell or the value used. And from the question, the fair value less cost to sell is 6,500 and the value used is 3,400. So the fair value less cost to sell is greater than the value used. So we should use the fair value less cost to sell as the recoverable value. Simple. So any question, I want to move to another accounting standard. The remaining solution, you can find it from the recording session. Any question?
No, sir. For me.
Look at this one. Very simple. Any question?
No, sir.
No, sir. No, sir.
So if no question, we can move to IS2, which is inventory. So now, basically, IS2, it's not much that difficult. You just need to know how you can calculate using the cost model, the value of the inventory, and how are you going to value your inventory according to IS2. So basically, the concept of IS2 illustrates the accounting treatment for inventory. How are you going to account for inventory? How are you going to treat our inventory? So basically, we are going to look at the recognition, the measurement, and how are we going to do our subsequent write down of inventory value. So under IAS2, we are not going to consider construction contracts. It is out of the scope of IAS2. We are going to cover it under IFRS 15. Don't worry for now. IFRS 9, we are not going to apply it to IAS2. For example, the banking industry, the inventory they have, they can't use the IAS2 to account for the financial instrument. Instead, we are going to use IFRS 9. Biological asset IAS 41, we are not going to use it. So example of inventory, we can talk about goods held for sale, work in progress, raw material, consumables, purchase, goods for resale, whichever. So now, when we are talking about inventory, you need to know the definition of inventory. So when we are talking about inventory, any asset held for ordinary course of business. For example, asset that we can use to generate revenue. For example, we are producing pure water. Pure water will be an inventory because it's our normal course of business. That's the reason why the business is in existence. So if we are going to sell the pure water, the inventory, then we are going to use it to recognize the revenue. So that's the first category. The second definition, in the process of production for short sales. For example, we are talking about the work in progress, or we are talking about the consumable. So if when we are talking about consumable in real sense, for example, the mining or the manufacturing company, let's say the mining company, right? Within the mining process, we have a specific categories of consumables which can be used to support the day-to-day operational activity. For example, the plant that is used to further process the mineral, whether it's gold, it's silver, whichever mineral, that plant that is used to process the mineral further to its final product Let's assume a component of the plant has a problem. We need to replace it. We need to change it. So whole aspect of the plant, every bit and component, which is significantly important, you can classify it as a consumable. You can account for it as an inventory because we are going to use it to support the process of production for short sales. So that particular category is what we refer to as a consumable. We also need to account for it as an inventory as per IAS 2. So now, what is the valuation? How we can measure our inventory? We have the concept of net realizable value. That is, if we want to sell the inventory now, what will be the value that we are going to sell it for? So the net realizable value is the estimated selling price in the ordinary course of business, less any estimated cost of completion or any estimated cost necessary to make the sale. Very important point, you need to know how you can calculate your NRV. NRV can be your selling price in normal course of business, less any cost to sell, or we can less any estimated cost to make the sale. Every sales, the cost that you are going to incur to make that sale, you are going to deduct it from the estimated selling price. So it can be the estimated selling cost distribution, whichever. So now, for the cost, we need to know what components of cost are you going to include as part of the cost of the inventory, because it's very much important. We should not overstate the value of our inventory, because overstating the value of our inventory has significant impact on the financial statement. One, it will reduce our profitability. It will increase the chance of selling price so that we can increase our selling price, because if the cost of production is high, then the business might not make profit from that particular production. And also, it will overstate our asset value because we are going to show it as current asset in the financial statement. So it is very much important the valuation of your inventory is 100% correct. So you need to know the factors that we are going to include when we are going to value our inventory. Firstly, we are going to consider the purchase cost of purchasing the raw material. Now, if we are producing, let's assume pure water, the bottle, the water, the branding, all of these costs, we are going to include it as part of the cost because the purchase cost should be included. Also, if we have any cost of converting the raw material into finished good, we are going to include it. Also, any cost that we are going to incur to bring the raw material, to bring the purchase item to its present condition and location, we are going to include it. So firstly, we are going to consider all direct costs to bring in the purchase item, to bring in the inventory to its current location and condition. We are going to include not only location, condition should also be considered when you are going to calculate the cost. And also all conversion costs that we are going to use to convert the inventory, whether it's a raw material, we need to convert it to finished goods or whichever conversion that we are going to use. So basically, a further breakdown of the component, the cost, we are going to look at the purchase price, we are going to look at the import duties and taxes, we are going to look at transportation and handling cost. Then if there is a trade discount, we are not going to consider the trade discount. It's a deduction. We are going to less it off from it because if the company made use of the trade discount from the supplier, then it's a benefit for the company. It will reduce our production costs. So you need to know this component. It is tested in the examination. Then for the conversion cost, we have direct costs. For example, the cost that we are going to pay to laborers to convert the raw material into finished good, the direct material. So we have the production overhead, which can be systematically allocated, whichever the situation might be. We can consider it. If we have a specific machine that is used to support the production process, those depreciation that we are going to charge on the machine, the rent that we are going to pay for the factory that relates specifically for the production, those charges should be included as part of the cost of the assets. Now, for example, the business operates the factory, the manufacturing process in a separate location from the administrative purpose. So now the cost that we are going to incur for the factory, we are going to prorate it, we are going to include it as part of the cost of the asset. Also for depreciation, if the asset, I'm not talking about all depreciation, if the asset is specifically used to support the production or the conversion of the raw material, the inventory to finished good, we are going to include this fixed overhead, variable overhead, indirect material, whichever it might be. So basically, this is just an approach in which we can allocate the various overhead. So we have other costs that we are going to consider whether we should include it or not. This is very much important. We need to only include cost if it brings the inventory to its present condition. If the cost helps to bring the inventory to its present condition, then we can include it. For example, design costs for specific customers, transportation to production sites, we can include it because if we did not include a specific design, the customer might not want to purchase that particular product from us. The transportation to production sites, it's obviously we should include it. Every transportation we should include it. Then we should exclude storage costs, administrative costs, selling costs, and abnormal waste. We are not going to include these costs as part of the cost component when we are going to determine the value of the inventory. So basically, we have inventory valuation method, the unit cost, first in, first out, and the weighted average. You don't need to worry about it. So now what you need to know, after we have completed the initial recognition for inventory, for the initial recognition, we are not going to apply the IAS 2. In other words, the law of the cost or the net realizable value. No, we are only going to implement the law of cost or net realizable value for subsequent measurement. In other words, after we have completed the initial measurement, the cost measurement, the next year, how are we going to measure our inventory, which is the subsequent measurement? We can use higher, we can use the lower of the cost on the net realizable value. This is similar to the recoverable value, but we are going to use the opposite. Instead of higher, we are going to use the lower. Inventory should be valued at the lower of cost or any NRV. So in other words, if the cost is lower than the NRV, we are going to state the asset value, the inventory value at cost. If the NRV is lower than the cost, we are going to state the inventory value at the NRV. This is what you need to know. Nothing more, nothing less. We are going to compare the cost and the net realizable value. The lower of the cost and the NRV is what we are going to use to determine our value of the inventory, the value that we are going to show in the statement of financial position, right? So now, if the NRV is less than the cost, inventory must be written down immediately. If the NRV is lower than the cost, we should write down the value of the inventory. The reversal of write down inventory. If condition improve and the NRV rise, then reversal is allowed, but only up to the original cost. In other words, we should not reverse the impairment beyond more than the original cost. So basically, this is the concept of impairment. You can look at the solution. So nothing to worry about don't worry about disclosure. This is for the strategic business reporting students, how to disclose the impairment. For this level, we don't need to worry about it. So basically, look at question, very simple and very straightforward. This is how the question is tested. Inventory is not difficult. So question one, IS2, inventory specifies expenses that should be included in the year-end inventory values. Which three of the expenses below are allowable by IAS2 as expenses that should be included in the cost of finished goods inventory? Which three of these expenses should be included? A, we have the marketing and selling overhead. B, we have the variable production overhead. C, we have the general management overhead. D, we have the factory management overhead allocated to production. E, we have cost of delivering raw material to factory. F, we have abnormal increase in overhead charges caused by unusual low production level due to the exceptional or exceptionally hot weather. So what will be the answer? We are going to solve it together. What will be the answer? Option A. What is the condition for option A? We should include it or not?
I think it should be included.
Marketing and selling costs. Okay. Any other idea contrary? Okay, Laura too. What are your options?
A, E, and and D.
You
Factory
said
management.
A, E and
A,
D.
D, and E. A, D, and E.
A, D, and E. Okay, D is talking about factory management overhead allocated to production. E is talking about cost of delivery raw material to factory. Okay, any other suggestion?
B, D, and E.
B, D, and E. So the B is the variable production overhead. Okay. Any other option? Contrary. So the okay. So basically, the correct answer B is correct. Variable production overhead. D, factory management overhead allocated to production, and E, cost of delivery raw material to factory. A is wrong because marketing and selling cannot be included as part of the cost of the inventory. Now look at example 3. Very important. At what cost should Mario value this inventory in its financial statement? At what cost should Mario value this inventory in its financial statement? At what cost? Mario has incurred the following cost in relation to a unit of inventory. We need to calculate the cost. Raw material, input duties, direct labor, subcontractor labor cost, recoverable sales tax, storage cost, production overhead. There was a problem with the first batch of item produced, so abnormal wastage cost of 0.1 per unit have also been incurred by Mario. So what cost are we going to include? Can you tell me? Raw material cost. What is the option about raw material? Should we include raw material? Yes or no?
Yes, sir. Yes, sir.
Yes, sir. Raw material.
What about import duties?
Mm, import duties.
It should be included also.
Forgot Not, not really, because it's not part of the production cost.
Okay.
It should be included.
Okay. Direct labor,
Yes,
It
sir.
also should, yes, sir.
subcontracted labor cost.
Yes, sir.
Mm, I don't think so.
Why?
Should be included.
Because it's not a direct labor cost. Subcontracted
It
labor
should be
cost.
included.
It
Yeah,
should be
it
included.
is a
Okay.
subcontractor, but
Okay.
it's because of the production process.
Okay.
Recoverable sales tax.
Mm, should not be included. It's
It
an
should
overhead.
not.
Okay. What about storage cost?
Yes, sir. Storage cost should not be included.
Okay. What about production overhead per unit?
It should.
Okay, should be included. Okay. What about the abnormal waste? The 0.1.
It should not.
It should not be included.
So from this particular example, what did you learn from this example? So it means you need to pay attention on the components of cost. This is how the question is given in the examination. So you need to know. And to be frank, if you miss any of the points, you are not going to get any mark.
Exactly.
So you need to understand the content. You need to know why Are you going to include any cost as part of the cost of inventing it, and why you should not include? And by default, you need to know the various costs that you should be included and the costs that you should not include. So when you're studying, you need to pay attention on key information and on key details. Okay. This is very simple. The call is I don't know this about on recording session itself. Eh?
Not this.
Watch the recording session itself. What happen? I pause the recording first, but I'll charge you now small.